Good evening, folks. Welcome to episode 3 of the MAFATA series. Before we go on to our stock pick choice, let's take a look at the overall market for the month of May. Generally, for May, we have the sell in May and go away, but it seems like for the S&P 500 and the Nasdaq 100, May seems to be a very good year. Of course, this is mainly driven by the whole AI mania. We have Apple and Nvidia giving a very good earning, and in fact, I'm sure all of you know, Nvidia went up 25% on the earning day itself, all the way to $380. It is the all-time high. It is in fact extremely crazy, and due to this, we have the rest of the tech sector going up as well due to all this AI hype. So as you can see here, Nasdaq definitely outperformed the S&P 500. This is due to a simple fact that Nasdaq is a tech-heavy index, whereas S&P tend to have exposure to the financial sector and the energy sector. And I think recently the energy and the finance sector not really doing that great compared to the overall the tech sector. So S&P slightly underperformed the Nasdaq 100, but the Nasdaq 100 is definitely a winner here. So on the other hand, we have Dow Jones, who is returning a red candle for May. And in fact, Dow Jones is severely underperforming. And while the tech folks are out there partying, all the industrial and healthcare companies that is weighing down on the Dow Jones is not really that well. In fact, I will go on to say that Dow Jones is not a good index to trade. If you're an index trader, I rather you stick with S&P or Nasdaq 100, because those indices are a lot cheaper compared to Dow Jones, meaning to say if you are on a CFD platform, or if you are trying to trade the actual ETF itself, right, it is a lot cheaper compared to the Dow Jones. And Dow Jones actually is heavily weighted towards mature and defensive companies such as Johnson & Johnson, or even the industrial company that are not really doing that well currently right now. Okay, so stick to S&P 500 if you want a little bit more diversification, or if you want to go all in YOLO into the AI mania, right? Nasdaq is the way to go. So talking about Nvidia, we have the 30% rally all the way from 300. In fact, every week, every day, whenever this company goes up, I was looking to take a counter trend short position, because I mean, how far can it go? How far can it go? But I never really pulled the trigger because it seems like quite risky. And in fact, during the earnings day itself, I was working out on some option structuring for the downside, and none of the option structures seems to be attractive, so I decided to not do anything for Nvidia earning, and it did went up 30% from the close from the previous day closing before the earnings. So I was quite, in a way, lucky to have escaped this. The reason for the gap up for Nvidia is because they announced that for the second quarter fiscal year 2024, the revenue outlook is actually 11 billion. And that's the reason why Nvidia went up, mainly because if you look at their quarterly revenue, they have not once cracked above 10 billion. In fact, for quarter one of 2023, they have a total revenue of 7.19 billion. And in fact, if you look at the revenue growth, it has been contracting since quarter 3 2022. So right now, when they are forecasting 11 billion, right, it is about 60 to 70% growth. It is the kind of growth that we have yet to see since the 2020-2021 rally. And that's probably why Nvidia right now is back at the all-time high. So I just want to cover a bit on Nvidia itself. Mainly because right now the stock market is actually ignoring all the macro elements, and the entire market is being driven by the individual performance of certain companies. For example, companies like Nvidia and Apple and Microsoft, and of course all the growth potential of all these companies when we talk about the whole AI integration. So the entire index is actually driven up by company performance or forward companies growth. In fact, all these big company names that I have just mentioned, they have a very heavy weightage on the index, such as the Nasdaq 100. Thus, it pulls up the entire market. So whatever ongoing issue that is happening in the macro environment right now, the market is not really paying attention to it. The market is totally ignoring all the macro related stuff. And that is one of the reasons why I don't really want to talk about debt ceiling or go into the intricacy of debt ceiling, simply because the market is ignoring it. The market does not want to do anything with debt ceiling for now. Whatever happening there, right? The market is not responding to it. Whatever on the macro side, the market doesn't care. The market only cares about the AI mania right now. But does this mean that going forward, all these negative or these pessimistic macro views are not coming into play? No, in fact, maybe once the AI mania die down in the future, all these bad macro will start to take effect in the market right now also. But just because the macro is bad, it doesn't mean that market must always go down, because the market is driven by a lot of factors. Macro is one of them, and then we have individual stock performance, and we have the sector performance also. So currently right now, the entire AI chip tech sector is doing a very strong recovery, along with individual performance from companies such as Nvidia. And talking about macro also, we do see the dollar actually rallying quite aggressively recently, but the stock market doesn't really care about what the dollar is doing right now. On a 4-hour dollar chart, we do see the MACD kind of flattening out a bit, and the RSI is also going into the overbought territory, and we may see a short retrace, a small retrace in the dollar. So that will be a good thing, because if dollar provide us with a very small amount of retrace, right, we will be able to get into gold short. In fact, we are looking out for gold short for quite a while, but I do not really want to chase this current price level right now. And even for gold, right, you can see the MACD kind of bottoming out, and the RSI is going up from the oversold territory. So we may see a small recovery in gold, probably towards 2000 level like that, and that is where I will want to place my short position. But if going forward gold decide to crash all the way, right, then I wouldn't really chase the trade. I'll just let it go. And more on the macro portion, we also have the PCE data that came out Friday, on the 26th May. And we can see the PCE start to spike back up. It's PCE inflation data. So the forecast is 3.9. The actual is actually 4.4. So it is 0.5% higher than the forecast. And in fact, it is actually higher than the previous reading. So now we are starting to see the inflation U-turning back up. And in fact, I was looking for the CPI data. The CPI is coming 15 June, I believe, but there were no forecasts on the CPI yet, so I can't really tell what is going on the CPI end. But if the PCE is going up, I will say that the CPI probably will spike back up as well. And this is very important because we have the FOMC meeting coming up in June as well. And for June FOMC meeting, even though the plan for the previous meeting was that they announced they are going to pause, but it is not really a hard pause. It is more like a conditional pause, where they will see incoming data, and they will see what is going on in the overall economy, and they will decide whether they need to re-hike or not. So it seems that based on the Federal Fed Watch, the probability for another 25 basis point hike is actually 61.9%. So this is quite this is quite a high probability of another rate hike, especially when Federal Reserve actually announced that they are going to keep at 5.25 lah. But what is interesting is that for the June FOMC meeting, there will be a projection material coming out So Federal Reserve, FOMC provide projection material every 3 months. So the last one was in March. So we have the new one coming out in June. So within this projection material, we shall see what is their final target for the federal fund rate for 2003. Are they going to raise the final target, or are they going to keep at 5.25? So currently it is at 5.25 right now. So if they decide to keep at 5.25, then most likely in June they are not going to hike again. They are going to just keep it at 5.25. So there's a lot of interesting macro stuff that is happening in the economy right now, but it is also good to acknowledge that market is currently not paying attention to it. And if the market is not paying attention to it, there is no reason to fight the market and make a lot of macro related trade. We wait for the macro factors to play out, wait for the market to respond, and then we will start looking at certain macro trades that we can take. So currently one of it is, as I mentioned, gold. But in the future, I do think that the home builder sector may start to decline, because we are seeing the inventory level on home builder quite high, and they are failing to unload this inventory because there's actually no buyers. So now let's move on to our company of choice today, Okta. So what exactly is Okta? It is a tech company. So we are trying to ride on the AI hype, all this software, cloud, AI services. But of course, we also want to choose certain company that has good fundamental, good growth. Not only that, they have not gone up to a crazy high level yet, meaning it is not still too late to chase this particular stock. If you ask me, Nvidia is probably too late to chase. I do not really want to chase AMD as well. So I was looking around, I was shopping around, doing dumpster diving to see what else are there in the trash can, and I managed to pick out Okta. It is not to say that Okta is a trash company. We will go through the fundamental. It is quite okay. It is quite okay, but it is one of those that have potential growth, but it has not gone up so high. There's still some meat left on the bone. It is one of those company lah. Okay, so Okta, let's look at the overall sector. The sector average for revenue growth is around 11.94 for 2023 and 9.83 for 2024. And Okta actually have a higher than sector average revenue growth with 16.78% for 23 and 18.52% for 24. That is definitely good, but what I want to focus on is the earning growth for 2023. So we have the sector average earning growth is 33.05 for 23 and 100% for Okta. So this 100% is something that I want to clarify further, mainly because Okta don't really have a 100% earning growth for 2023. But normally, when a company go from a non-profitable state to becoming profitable, meaning they are loss-making and now they are actually in the positive earnings. So when we see a loss company projecting to go to a profitable company, we give a scoring of 100%. So I'm not really going to discuss the reason or the calculation behind this 100%, but that is what we basically look at. That's the scoring that we give. Nonetheless, if we look at year 2024, we are also seeing 53% earning growth in year 2024, which is about more than twice of the sector average at 25.43%. So the idea is that in this year, this fiscal year, Okta is going to become a profitable company from loss making, and then eventually they will continue to grow at a 53% earnings growth for the upcoming year at 2024. So with this backdrop, right, it does seem that overall, on a quantitative level, Okta seems like a very strong company. So what exactly is that they do? So Okta Inc provides identity solution for enterprises, small and medium-sized businesses, university, non-profit, and government agency in United States and internationally. So they provide identity solution, meaning if you need to log into something, right? For example, you sign up for a certain service at a certain web page and you need to log in with your email or whatever. As long as you need to log in something, Okta provide the solution, the cloud-based solution for all these kind of sign-in related softwares. So some of their local customer are Singlife with Aviva, SPH, CTU, and on a global basis, we do have big companies like FedEx or even Zoom. As long as you need to log in with something, the security, the login credential and information, right? Okta provide the solution. So it is a very big market, extremely big market, and you can see that the entire total addressable market is about 80 billion, and Okta is like a small tiny chart, a small part of the big pie, which is good because it means that there's actually a lot of room to grow. So as mentioned, we are looking at the if we look at the profitability of Okta, right? Okta has been loss-making for quite a number of years lah. Ever since the IPO, they are actually loss-making now. Okay, but during those loss-making period, they are actually growing their top line, growing their sales. They have quite a bit sales and marketing budget, so they are deliberately spending more than what they are earning in order to grow the market share, in order to grow the top line lah. But in the current macro environment, because we have challenging economic condition and we have high interest rate, all this, right? Okta is actually looking to cut down on a lot of expenses, and then they are trying to become profitable for the year 2022. So they are shifting from a revenue growth company to become a profitable company. So going forward in the entire year of 2023, right, the share price of Okta will be driven more by becoming profitable than actual sales growth. So becoming profitable is actually a very good driver for increase in share price. Whenever a company from a loss making in their first quarter of becoming profitable, the share price actually can rally quite significantly. For example, if we look at Palantir is one of the trade that we got earlier this year. You can see that during their first profitable quarter, the share price gap up about 10-20%, and in fact on the subsequent quarter they are able to sustain the profitability, and we managed to see the share price rallying even more. So if we look at early 2023, when the share price was around $6, we actually see Palantir rally more than 100% all the way to $13.65. So becoming profitable is not something to be taken lightly in terms of share price appreciation. So looking at the overall revenue, the income statement, right, you can see that they make a total revenue of 1.86 billion for 2022. Removing the cost of goods sold, right, the gross profits is around 1.31 billion, but you can see the bulk of their expenses is coming from the operational expense, the operating expense at 2.09 billion, which make their operating income become negative at negative 776 million. So the operating expenses are some things that they have to sort of watch out for. What are the kind of stuff that they are spending on, and they need to ensure that they are more efficient in terms of the stuff that they are actually spending. So we take a closer look into what is the operating expenses. We have research and development, sales and marketing, general and administrative, and as of last year, there was a restructuring and other charges. So this restructuring is their firing people, they want to cut down on expense, so they do need some amount of money to pay severance package, all this kind of stuff lah. So that is actually restructuring, which is good, because going forward in the upcoming year, right, we will start to see the expenses start going down. And from the look of their overall operating expense, right, sales and marketing make up the big bulk all the way at 1.06 billion for the year of 2023. So as we dive a little deeper into sales and marketing, right, you can see that it takes up a total of 58% of the total revenue. And in fact, during their statement, when in the most recent income statement, they say that they expect the sales and marketing expense will continue to be the largest operating expense category, because they still need to gather a lot of customers. They don't want to look up, they don't want to miss out on the market share itself, because as you can see earlier, right, the total addressable market is actually a very big pie. And if they kind of slack on the sales and marketing portion, right, they may miss out a lot of key customers. So yes, you do want to cut some costs, but you don't want to totally cut off the sales and marketing as well. So the sales and marketing will continue to be their largest expense category for a foreseeable future as they expand the sales and marketing effort. But the key thing is, but in short term, the sales and marketing expense may increase as a percentage of the total revenue. However, over time, they expect this percentage to decrease as of total revenue growth. So for now, right, it may be going up a bit, currently at 58% of total revenue, but over time, in the short term, over time, maybe for the next 1 year or for the next 2 years, this percentage will start to go down, maybe from 58% become 55%, become 54%. So they are looking to cut down a bit on the sales and marketing, but still, I must emphasize that it will still be the major, it will still be the largest operating expense category. So another thing that is a huge part of their expense is the stock-based compensation. You can see that the stock-based compensation is quite a lot also, $677 million in terms of stock-based compensation. And I have calculated the overall percentage as part of their overall percentage of the total revenue. So in 2023, they spent 36% of their total revenue on stock-based compensation. So it actually went down compared to 2022. But you can see from 2021 to 2022 that there is a sharp increase in the amount of total stock-based compensation expenses, from 195 million in 2021 to 566 million in 2022. And this is because it is due to their acquisition of Authentication Zero acquisition. Due to that, the stock-based compensation actually went up in 2022. But they say, they have mentioned here that they expect the stock-based compensation to be in the low 30% range for 2024. So they expect the stock-based compensation expense to slowly decline over the years. Currently, it is sitting at 36%, and quarter by quarter, it will slowly decline as the Authentication Zero acquisition, the impact of it slowly begins to roll off. And they state that they will remain committed to further reducing the stock-based compensation and dilution over the long term. So that's a good thing to hear. That's actually a very good thing to hear. A lot of all this startup company, right? One of the things that you may not really notice is the effect of the share dilution from all this stock-based compensation. So as as employees are compensated via stock, the amount of stock available for this particular company in the pool actually goes up. So it is kind of like inflation like that. your one share of whatever you are holding no longer worth as much as what it used to, because of the fact that the amount of share available actually increased. So I was looking at the overall total common share outstanding, and you can see that it went up quite significantly. There was a very sharp spike in 2017, but that is because it is their IPO. They IPO in 2017, so they have sold a lot of their the company shares lah. But as we move towards to 2021 and 2022, right, you can see the dilution kind of slowly starting to slow down from 156 million in 2021 to 161 million in 2022. So it is good thing. It is a good sign, and hopefully for the year of 2023, right, we start to see this total common share outstanding kind of flatten out and no longer increase as much. So from their 2023 transcript, Q4 transcript, right, they said that they have taken action to significantly reduce the cost structure while maintaining key investment to fuel future growth, and they are confident that they have set the path for many years of profitable growth. So the reason why I am pointing out this is that it is important because, as mentioned earlier, right, the share price, the driving force behind Okta share price will be becoming profitable, and it seems that the management themselves, they are aware of it, and they are taking all the necessary action that is needed in order to improve their company efficiency and in order to cut down all these unnecessary expenses. So in 2nd of February, they cut 300 jobs, citing over hiring and execution challenge, and of course, as mentioned, right, they incur 50 million in the restructuring costs for the for this cutting costs lah. So they are doing something, and in fact, for the entire of last year, we do see that companies who start to cut costs, fire people, the share price tend to rally because of the cost cutting effort. We did see companies like Meta went up quite aggressively over the entire of the second half of 2022 due to their cost-cutting effort. And in fact, now they are becoming to be very efficient in terms of the profit margins again. And hopefully Okta will be able to follow such step. And in fact, if we look at the latest quarterly earning, right, we are able to see some impact of all these effort, but the big effort, the big effort is this restructuring program, and they announced in 2nd of February, meaning to say that whatever that they are doing in terms of cost cutting, right, it has not taken effect yet. But we hope to see all these effects start to show material impact on the income statement in the upcoming earning or in the next earning or over the entire 2023. And once they start to materialize, you will see the share price of Okta start to go up. But for the last quarter, a few things that we can take note is if you look at the overall total revenue, there was 481 million revenue in Q3, 510 million revenue in Q4. So the revenue actually went up about 30%, but the expense actually went down. So in Q3, there was 549 million in operating expense, but in Q4, right, there's only 513 million in terms of operating expense. So even though the revenue went up, the expense actually came down, and it seems to be a conscious effort on the management part to start cutting costs. So as long as your revenue is going up, your expenses are flattening, or your expenses start to go down, right, we will start to see profitability in the near future. And in fact, if you look at the overall net income at the bottom of the screen, for the first time, I believe the net income, okay, this is not net income, this is actually net loss. The net loss actually went below 200 million. So they are slowly narrowing the net loss hopefully it will become positive in the upcoming quarter. Okay, so this is to show you that that there are conscious effort that is being taken by the management in order to reduce the operational costs. And if you compare this to Snowflake, right? In fact, Snowflake earnings came out not long ago, and the company, the share price actually dropped about 15% or 20%, but it is quite a significant drop. And one thing you can see is from Snowflake is that it is quite similar to Okta in terms of their revenue and the operating expense. Snowflake is actually a loss-making company, but in fact, they are not doing anything to make themselves profitable. They have been loss-making for very, very long, very long already. And in fact, the operating expense just continue to increase along with the revenue, and the market doesn't really like that. So right now, market is rewarding efficiency. Okay, market is rewarding efficiency, strong profit margin. They are not really looking for growth really. They are not really looking at revenue growth, but what they want is cash flow, operational, positive operating income. These are the stuff that the market is looking out for. But on the growth side also, this company is doing fine. It's not like they are totally abandoning the growth in order to become profitable. The majority of their KPI are on the uptrend, which is good. For example, the total customers is up about 17% year over year, and the dollar-based net retention rate is about 120%, meaning they are retaining most of their key customer. And not only that, right? All these customers that they are retaining, the customer are actually spending more and more, which is why you see retention rate above 100%. And overall, the total revenue is up 33% year over year, and the major portion of their revenue, which is the subscription revenue, is actually up 34%. So on the growth department, right, the growth is still there, but at the same time, they are making the conscious effort to cut down on costs and improve their efficiency. So this is actually from their presentation during the last earnings. Key takeaway: strong foundation for growth at scale, large addressable market with multiple growth vectors, and position for profitable growth. So of course, this is definitely the drivers for the company to become profitable. These are the drivers for the share price to actually go up, which is the company becoming profitable. But once again, right, we also cannot discount the overall unattractive macro environment that we are in right now, and that is the reason why the company is shifting to profitability due to the current macro environment. It does not reward growth due to the inflation, due to a lot of customer actually cutting costs. And in fact, Okta did mention that they are gaining more revenue from existing customer because the existing customer are upgrading their software, their package, or the existing customer are growing in terms of their user base. Hence, they require more products, more services from Okta. But Okta themselves have admitted that they are not really seeing any new customer coming in. So that is something that we need to take note of, and that is something that the management is definitely aware. So now let's move on to the technical part. The technical part of this presentation. We can see the restructuring announced very recently in 2nd of February, as mentioned earlier. And one thing to take note, Okta is already up about 34.9% since this year, 2023. So year to date, it is up 34.9%. I would not say this is a big rally, but if you want to sort of count from the bottom, meaning the bottom of the chart itself, which is somewhere around $40, then yes, this stock is up about 40%, up about 100%. But looking from year-to-date perspective, it is up about 34.9%. So there is always this question of, is it still possible to chase? Can we still chase this company or not? I personally like to chase because the market is always forward looking. Okay, so if this company can truly become profitable at the same time they are able to stick to their growth strategy, right? Then we may see this company going back up to like above 100 level. It is something that we have seen in companies like Palantir, where they are able to become profitable but still maintain their growth. So this is something up to individual investor, individual trader. You can definitely wait for the stock to go back down. That's a viable strategy also, but you do need a concrete plan. So I will go through that later. Okay, so we do see the MACD very positive. It is the MACD line is going above the signal line. You can see it right here, and it is going above the zero line, meaning to say that the upward momentum is very strong. And of course, the RSI have also gone up on a very steep uptrend. So this is definitely a strong upward momentum. And we do see a few support level. I would say the support level at 75.22, it is more like a light support. So it is not a heavy support, meaning it can easily break down. It can easily break down, but or if that level gets supported, right, it can bounce off from the trend line, but it is not as good of a support at 67. The 67 level is a swing point. It's a very strong swing level, and it is currently now marking the higher low. It is the uptrend. And we have the resistance level at 86.54. So looking at this, right, we have quite a number of textbook uptrend behavior. We have a higher low, we have breaking of the resistance, we have the price of the stock above the moving average, we have the MACD above zero, MACD above signal line, the RSI going up. This is definitely extremely bullish momentum. But what I want to sort of emphasize is that the earnings is on 31st of May post-market, which is one day from now, which is tomorrow. Tomorrow, after market close, the earnings will come out. And when the earnings come out, the stock can be a little bit volatile. It can break down, break up, so there can be a big movement. And if you are not comfortable with trading such movement, it may be advisable to stay out before the earnings and perhaps try to see what you can do after the earning, after the market have responded to the latest earnings. So let's say if the share price actually drop back to the support level, then you may have a very good entry at the support level area. So there are a few ways things can go for this particular counter. I am aiming my target level, the potential profit level, at 110. So 110 is about 25% up from the current price, and it is about 47% up from support level at 75. So now the key question is that, do you want to chase this at the current price, or do you want to wait for the stock to retrace a bit back to $75 like that, and then you buy in at a much cheaper level? And that will mean that your overall risk reward ratio will be a lot better. Your potential profit will be a lot higher. You can get more shares at a cheaper level. So looking at $67 as the swing level, this hard support here, $67, definitely I would want to place my stop loss below 67. But you can see that level, that support level, is 23% down from current price. So that's a very big downside if I want to put a stop loss below $67. So it is something that maybe you may want to work it out. You may want to see what kind of trade structure you can take. For example, you can enter half your usual position right now, and then the remaining half you wait for market to retrace, or you wait for earnings to be over, or if you felt that the market has Okta has rallied significantly already, you don't really want to chase the earning, then you may stay out of the earning, wait for the stock to go back down to 67 to 75, that level. It may be a better entry. Of course, it is totally up to you. There's no right answer, wrong answer. It is based on each trader's individual risk appetite and their personal preference also. Of course, in our Nimbus Capital Patreon, we have worked out a trade structure that we are comfortable taking. We are going for some option structure in order to take advantage of any potential upside while trying to reduce the risk if Okta kind of crash all the way down back to the support level. So we are accounting for both ends, both a big rally or a big downside, and we are quite comfortable with our trade structure. So if you want to know more about our trade structure regarding all the trade ideas that we are giving out, do consider subscribing to our Patreon, and you'll be able to learn more about how we take certain trades based on what we are seeing. Hopefully you guys able to get something out of this episode 3. So the next episode will be 2 weeks from now. Okay, so I shall see what can I dig up from the dumpster again. Hopefully something good. I do want to start sharing some short idea also. I think previously I mentioned I will share a short idea today, but I I kind of like this particular counter, so I wanted to share this counter first. I definitely do have a lot of short idea on my watch list as well. So I promise the next session will be a short idea. Okay, guys. If you like our channel, if you like what we present, do subscribe. It will help us a lot because we are trying to grow as well. Even though we are not a tech company, we do want to grow as well. Okay, guys. Have a great week ahead. Have a great earnings for Okta. Bye bye.